quality of all the people in it. And in practice, many mutual credits don't do that because of real world constraints. But I think of mutual credit as a sort of ideal to which we could strive for monetary equality. So having said that, I'd like to introduce you to Ashley and Julian from Resource.finance, who have been working on mutual credit very specifically and chaining it. And they have planned this morning's session. Would you like the microphone?
Thanks. Yeah, it's been great to be here with all of you and hear all about the theoretical underpinnings from a lot of different perspectives. So we're going to get into our system. We're going to get into how we're going about solving some of the problems that mutual credit systems encounter from our perspective. But before we get started and go into that, we're actually going to hear from Charlie of the Hudson Valley Current, and he's going to take us through a sort of what is mutual credit high level, and then we'll get into how Resource is taking that to the next level, or at least that's what we think.
Thank you. It's Chris. Yeah, thank you. I like Josh for you. It's okay. I'm Chris from the Hudson Valley Current. If you don't know where the Hudson Valley is, I brought a little map with me. So right here is New York City in New York State. And there's 7 million people in the 5 boroughs of New York City. There's 20 million people in New York State. And the Hudson River runs from Manhattan to Albany into the headwaters in the Adirondack Mountains. This is Washington. No, it's New York State. So first I'd like to start by using a Haudenosaunee Thanksgiving address, which is the French word is Iroquois. Many of you have heard of Iroquois, but the Haudenosaunee Thanksgiving address starts by thanking many of the elements. So I'd like to thank water and all of its men. And the native name for the Hudson River is the Mahicantuck, and that means the river that flows 2 ways. So because the ocean is here, the inflow every day is so strong that it goes up to Poughkeepsie, and the water is brackish here, salt and fresh. The fresh waters here meet around Poughkeepsie and Newburgh. And before colonists killed all of the whales around Manhattan, the whales used to come all the way up into the river. So this flow of water 2 ways is very natural. It pulls and pushes every day. And we're also very familiar with the flow of water in water bodies like this. I drew the capybara for Marcelo. Is he here? He's got a tattoo on his arm. But this upper water body has a natural flow down this waterfall. And you also have areas like this that stagnate. But this natural pull goes down the waterfall. But stagnation can be good sometimes. It creates life, moss, dragonflies, and then you have a natural pull this way, but you have pools that circle. And I think what's interesting about mutual credit is it has a natural flow because a user has credits in their account, which I'll get to in just a moment, and it's flowing naturally to the next space. But sometimes we forget about the hydrostatic tension in the 2 water tables, and the water is also being pulled this way underground. We see it more often in the ocean as the waves break. When we're standing here, you see the water come down and get wet, and you see it pull away. So there's a lot of action of push and pull under the waves here. So now I'll draw some charts that you all love. But I'm going to start with the humans because that's what happens in mutual credit. We deal with people all the time and their real world issues. Sometimes they're happy, and I'm just going to keep the happy members here. So every member in the Hudson Valley Current gets a line of credit of 300 currents, and we call it a line of trust because there's no interest and no fees. So each member can go below 0 by 300. And that is an arbitrary number that our board agreed on in 2014 when we started the project, because it's a healthy amount of debt, and it's something that almost everyone can handle. 300 credits isn't a lot, and once people start using it, we help them earn and we help them spend. So here we see an example of Charlie, not me, and Sue. And Charlie gives Sue 20 currents in our case, and she receives 20. So Charlie goes below zero by 20, and Sue goes into the positive by 20. Once we saw that members were going above and below zero, we created larger lines of credit for active members that can go to negative 1,000. So as I said, that was an arbitrary number that the board agreed on as a healthy amount of debt, but we saw that active businesses needed a larger line of trust in order to make frequent transactions. During COVID, when the pandemic hit, we saw the recession. Depression is the next one. But we saw the recession hitting in March 2020 because we went from an average of about 25,000 currents exchanged every month to quickly zero. And each week we saw zero action within the system. And we hit our emergency red button, which we were planning on because this is a post-Great Recession project. So we knew the next recession was coming. We didn't know exactly when. So that indicator made us change our behaviors a little bit. We started talking to our members about recession. We changed our publication to be weekly instead of monthly to talk about where you can find food and resources. And the third project, we started delivering food to 3 counties, hot meals and groceries. So we kind of sprung into action because of the recession, and the currency was the indicator. So thank you, Scott. Then we realized the government, I got so many calls in March 2020 and April, and people were like, "You're not crazy. You've been doing this project. I thought you were crazy all these years, and now I understand why you're doing it." So people started using it so much, the usage of currents tripled, and we went to about 360,000 currents exchanged in 2020. But then the government started bailing people out and created the Paycheck Protection Program, and I stopped getting so many calls. So we created something called the Current Resilience Plan for nonprofit organizations because they mostly sprang into action. And each of these members that applied can go to negative 5,000. This created a huge rush of currents, and it also created an affinity group between mutual credit members because they all had something in common to help the community. And now, because we have an exchange center where people can come and meet, that CRP group comes and makes sure they're moving currents back and forth between each other. So this is just an overview. I'll do a half hour more about Hudson Valley Current tomorrow. I just wanted to give you the idea behind the push and the pull of credits within a mutual credit system. The IRS in the US calls it trade credits or barter credits. And I just wanted to mention one more thing before I move on. The way we draw this now took about 2 years to draw it this way because I used to explain it like this to people. And nobody wanted to go below zero. It's the same graph, but nobody wanted to go below. And now I talk about it as skiing down a ski trail instead. And I also say that being in the negative is positive because if nobody goes there, currents don't exist. Okay, thank you.
Thank you, Chris. Okay, so Chris described some of the basic underpinnings of mutual credit resource. So we took this idea of mutual credit and we thought about how could this be a protocol that exists for everyone to use to create their own sort of mutual credit system. And as we started thinking about that problem, we also started looking at a lot of the other mutual credit systems that exist around the world. And we started looking at what are the common issues that a lot of these systems are encountering. Some of those issues are things that we've been discussing here this week. A lot has to do with, scale. A lot has to do with using them for everyday expenses. So we have taken an approach that we're going to share with you today around how to solve some of those problems. We'll talk about now how our protocol works in action, how potentially some of you could play around with it and start to maybe use it in some of your projects. Because again, it's an open source project. It's really meant to be something that we're providing and working with the community here. So I'm going to hand it over to Julian. Julian's our protocol architect. He is the brains behind a lot of this economic logic here. Julian's from Israel, and he's been with us from the beginning. And so we're going to go through some things for you today, and then we'll get to some more like practical applications at the end.
Hi.
You want this?
Yeah, I think so. Okay. Well, there are many ways in which we can talk about mutual credit. So the term reciprocal trade often pops up. Credit clearing, multilateral exchange. Is it money? Isn't it money? Barter credits. The way we look at mutual credit is well, one of the ways we look at mutual credit is as an insurance model for private money. So we talked a lot about what private money is, IOUs basically. So in the simplest setup of private money is like if Alice issues an IOU, pays Bob. Bob uses this IOU to pay Carol, and Carol closes the loop when she buys from Alice. Now, this obviously comes with risks. Alice might default, but even if she won't default, Carol may not trust Alice, even if Bob does. Okay, and if you like, you know, it's like the metaphorical Carol. Yes. So if I accept private money, I expose myself to a risk because I don't know who will accept it, and I also have no idea how much of it is in circulation, how much of it is backed. These are all risks, and these risks are natural. They're not bad, but they need to be managed. If we look at the same set of transactions in a mutual credit scenario, then we can basically the same thing happens, but by other means. Alice debits her account and pays Bob, and then Bob uses that to pay Carol, and Carol closes the loop by trading with Alice. Now, what we've actually done here, we have removed the personal trust requirement. The IOU is now not a personal IOU that specific individual has underwritten. Yes, the system, a collective, has underwritten it. Yes, which basically means that we have collectivized risk and also hidden it. Because me as a participant in the network, if someone defaults, they do not default on a specific transaction. They default on everyone collectively. So everyone who has a positive balance is basically affected by their default. Now, this is obviously a problem, but it's not just a bug, it's also a feature. Because this is the basis of insurance companies. This is what they do. If my house burns down, like this is Alice defaulting on me, I'm in trouble, and I may not recover from that. But if we all put our houses in a giant pool, yes, and we all commit to cover the losses if something happens, then we expose ourselves to more potential instances of risk. But if something happens to me, I'm better off. Okay. Now, this is just one side of the story, because this is not how insurance companies really work. Insurance companies reprivatize this collective risk by the fact that not everyone pays the same for their insurance. Okay. If my house is more likely to burn down than Ashley's house, yes, then my payments to the insurance pool will be larger. In this way, we get the benefits of both sides. We have like the risk is spread across the collective, but there's no moral hazard. Okay, no one can kind of exploit that because the contribution is relative to risk. The way we do that is we have differential transaction fees. So we do have transaction fees because every system comes with overhead and it comes with risk, and it needs to be paid for. In traditional credit, in the normal world, is normally translated into interest rates. If you're a risky borrower, you will pay higher interest rates than if you're a trusted one. And here it's kind of the same thing. So if you introduce a large amount of risk into the system, the transaction fees that you will have to pay to the network will be slightly higher than if you trusted. And now what this actually means is that we've ported the risk that was carried by the currency back to the individual user. Because in a mutual credit system, the currency is a risk-carrying instrument. Like if it carries risk. Someone might default, and in that sense, it kind of like behaves like an unbacked bond in some extent. In this way, we neutralize that. We take the risk and we port it back to the user, which means that the currency itself is now risk neutral. Okay, we'll show in a moment how that works practically speaking, but it means that everyone, if they understand the system, can now accept the currency and they're not exposed to the risks introduced by all individual users. Yes, please.
So if you borrow money from a bank, then you pay interest
Mhm.
once a month.
Yeah,
But here you talk about transaction fees.
transaction fees.
So it's a one-off,
Yeah, it's not compounding. It's not compounding. And there are many ways this could work. So we'll go into that in a moment. Yes, in our system, transaction fees, and that's the case with most mutual credit systems. Transaction fees are actually paid with fiat, or more precisely, fiat equivalent with stable coins. Yes, so we kind of use the stable coins to like neutralize the risk of the mutual credit currency. But this there are many ways to do that. Yes.
Okay. Yeah, I was just going to say, I actually like how if you borrow money from the network, you only pay once a one-off interest instead of a recurring one.
Yeah.
So
it doesn't explode, and you only pay for the risk. You don't pay for the cost of capital and the time value of money, and the and some creditors ROI requirements. Okay, so it's a transaction fee. It exists, but it cannot be compared with interest payments that a bank would normally charge. But the logic of how the risk is managed is kind of the same thing.
very nice.
Okay, so this is how this is done technically. This all lives on a blockchain, except the risk oracle over there, which is which is an oracle because it has to compute calculations that are a bit too much for the blockchain. What happens is if a new user approaches the network, an applicant, basically, they interact with a contract called the credit issuer, who interfaces with the Massa protocol. You've heard about Massa. They live on Celo, and they never mind. They do have kind of a sort of underwriting function, which we use in order to underwrite our user. The underwriting is done algorithmically, and many variables can flow into that. So the standard implementation would have it so that we just submit financial data and credit histories and everything that is objectively verifiable. And then we use algorithms that are not that different from algorithms. Like all banks underwrite algorithmically today. Like humans are barely involved in that. So we kind of like use that as well, but we can tweak that. We could rely on more social factors and less financial factors. But there is there is an underwriting mechanism, and you can feed it with your preferences, if you will. Yeah, it would probably wouldn't go in there, but yes. So the modularity would allow that, because this is the Massa protocol. It reads all kinds of data about you, and then it creates SBTs, soul-bound tokens, and this is we use that to like do blockchain stuff with it. Never mind. So the credit issuer assigns credit terms to you, which are your individual transaction fee, which is different from someone else's transaction fee, and your credit limit. Like how much, what are your overdraft privileges? Yes, and then our members, they pay fees. The fees go into the reserve. If someone defaults, this guy defaulted, yes, their debt is written off to a network debt account, which then individual members who have a positive balance in the network can service just by sending stable credits. We call our currency stable credits, sending stable credits to the network debt account, and then the reserve will reimburse them with stable coins reserved in the reserve. And now the reserve is not a black hole that just absorbs transaction fees and blows up to infinity if nothing bad happens. We have a risk manager that reads the aggregated risk of all members and the network activity, like velocity, volumes, so on and so forth, and attempts to estimate a predicted default rate of the network. And the reserve keeps only that part. Like if my projected default rate for the network is 10%, the reserve has 10% of all outstanding debt at every moment. And this kind of happens automatically if you think of it, because each transaction I pay, my transaction fee as a member is essentially my probability to default, if you will. Like if my probability to default is 7%, 7% will be my transaction fee, okay? Only if I dip into the negative, not if I do positive transactions. So in each transaction, every time I increase the amount of risk in the network, yes, I already automatically pay into the reserve the statistical amount that is required to like globally cover that. So it's like dynamically adjusts. So if transaction fees flow into the reserve, which are not required to further fortify it, then they either can flow back to the members in various ways, yes, just as cashbacks, basically. Like we can easily see who paid transaction fees in the past, who paid the most transaction fees, and just reroute them back to them. If this network is operated as a for-profit by network operator, then this would be their revenue, okay? Which actually means that as a network operator, if I run as for-profit, I cannot extract revenue out of the system if risk is not covered. So I only make a profit if I run a solid network. If I run a shitty network, I will not make profits, okay? But there are other ways. This could be run as a cooperative, and then the access of transaction fees could be used to issue fiat loans to members, for example. We have means to do that as well. Yes, please.
Are the credits convertible?
Not directly. They are not convertible. They are convertible only in this scenario. If he defaults, and this member here says, okay, I want to rectify his account. I see that I have the opportunity to do that. Then I can send my stable credits here, and I get a fiat equivalent from the reserve. But there is no market. There's no way to, there's no hard peg or something like that. It's impossible to like send your credit somewhere and get fiat in return, because this would defeat the whole purpose. Yes, please. That flows in, like, depending what you mean by the systemic risk. There is the use to determine the transaction fees take correlations into account. So correlative risk between the members, yes. There are also, yes, please.
Can you go again, read the step where
It's on? Okay.
Yeah.
There's the guy defaulting, and that's clear, right? So he's not paying back. He's dead.
He's dead.
He's dead. And
That's dead.
because shit happens, that happens.
Yeah, exactly. We'll get to
Sometimes
that in a
people
moment.
die.
Yeah.
And so somebody sees an event on the network, I guess.
What
Like
yes, what
I
happens
didn't get
in your
out-
wallet?
out-
What if you have a positive balance? You'll see a notice that says cashback available. We call it cashback for all kinds of better reasons. And then you can get a cashback on the transaction fees you paid in the past. And this is what happens. You surrender your tokens, and yes, please.
Yeah, but like, okay, Mario is dead. He owed 1,000.
Mm-hmm.
I have got 1,000
Mm-hmm.
in my account.
Yes.
I see a note, cashback available.
Mm-hmm.
And like you said that like the other member saw this, and that like the other member saw this.
Covering the default, yes.
So like I'm taking Mario's dead,
Mhm.
owes 1,000. I don't know him. I see this as an opportunity to get fiat.
Yes, if you need it, for example, if you, yeah.
And wait. So I send my positive 1,000 credits to the network debt contract.
Yes. Because Mario, it has already assumed Mario's dead.
Yeah. No, Mario's not coming back. It's a hole in the thing.
Yes.
But like, so I've
To
earned.
me, Mario.
Yeah, I've earned 1,000.
Mario always comes back, though. Never mind.
That's Super Mario.
Yeah.
But oh Jesus Christ! Well, whatever. Somebody who comes back from that.
Both interacted with mushrooms. Never mind.
No, but like the last bit is unclear to me. So cover the debt, and I get basically a redemption right.
Yes. You know,
'Cause-
you get stable for
Oh, okay.
You get money. You get a fiat for that. It's stable coins. yes, but-
No. But the cash equivalent.
Yeah,
let's
you get
say.
a cash equivalent, exactly. From the reserve, which has been funded by transaction fees paid by all members. It's an insurance pool, basically. This is how we like extract.
No, I got most of it.
Oh.
Is that happen? Has that happened already? Like,
Yeah, we
'cause
have a demo. You'll see the demo in a moment.
No. Like real people doing that. Okay.
No, I know, okay.
No. I mean, it's a nice design. I'm saying like.
Yeah, and by the way, there are other ways of doing that.
Yeah.
We're doing it voluntarily, so you can claim. So because that's like the most, I don't know, polite way of doing it. But you could demorage the system and just send everyone money according to a function that you build. There are many ways of doing
Yeah,
that.
no. That's clear. It's just really. I mean, I'm not even thinking about legal stuff. Like the logic.
This
of-
is legal, by the way.
I can't believe that.
Mm-hmm.
You must have underwritten some sort of contract. This won't work without private contracting.
Of
I
course,
guess.
yes. This is normally a cooperative.
It's taken from a cooperative structure. Oh, in that case, I see if Mario and Mario's dad and the other guy were members of a co-op, that would sort of follow logically. And
I
it
don't
could
understand what doesn't follow logically, though.
No, I mean,
Where's the problem?
my problem is like I don't know Mario. Mario is dead.
But you don't care about Mario.
No, wait.
No.
I have 1,000 credits that
Yes.
I earned selling pizza to Mario.
Yeah.
Yeah, but Mario is not paying back. So somebody else is paying back.
The reserve. Yes, the reserve. It's a
Okay.
collective insurance. And Mario, all his existence in the network has paid into this insurance pool.
Good.
And this is why this works. Yes. So, but is fraud possible? Yes. Yeah. So legally, and we'll get to that in a moment. Yes. I'll continue with your permission. Legally speaking, if you default on your debt, and then in a moment we get to what default actually means, you owe your that amount in fiat basically to the network. But we don't need that. We don't need that for the network to be stable. It's just there need
Last
to be
resort.
consequences. We'll get to that in a moment, though. Okay. So yeah. Next. So what we have here actually is it's not really in this configuration. There are different configurations, but in this configuration, it's not like a completely unhinged, depegged alternative money thing. It's a complementary currency, soft pegged to fiat. When I say soft peg, I mean that it's not hard pegged in the sense that there's a guarantee or a supposed guarantee that if you send tokens here, you get money back. It's soft pegged in the sense that there are mechanisms in place and dynamics in place that drive prices within the network to reflect prices outside of the network. Okay, you have a relative price stability. If Luigi offers his pizza for €5, yes, in the fiat world, he will probably charge 5 resource euros, whatever, and this will remain pegged. Yes.
If it's not convertible, why you need to worry about this? It could be hard pegged.
Yeah, because we think about the users and that want to use that to do actual business, and they need to be able to run their businesses and calculate and price things. And
Do you mean the perception of value relative to fiat?
what?
The perception of the value of each unit relative to fiat?
One-to-one. This is how it's set up. Of course, it never works like that. Okay, because in this also in fiat doesn't work like that, because you prefer cash over credit, and you pay premiums on this and that. But largely speaking, since we have the transaction fees in fiat, and we get reimbursements every now and then where that works one-to-one, and I know, yes, as a member, that if I have a debt within the system and I do not fulfill it with the system, I just walk away from it, I remain with an equivalent fiat debt. Okay, this drives me to price goods and services the same way I would be, because the debt is as real as fiat debt, and this is why
Okay. So what
I
you're
see the
saying is
economist
that
nodding.
so it's not pegged one-to-one by contract, but
It's not pegged. No. This is why it's soft pegged. It's not hard pegged. Okay. There is no one is forcing you to do anything. They're just mechanisms. There are market forces at play that kind of like nudge it in that direction.
Right.
Okay. Now we talked about default. What happens if you default on your debt? And we need to explain what default means, because it probably doesn't mean what you guys think that it means. So this is automated credit reallocation, which the protocol does. At the end, credit periods are normally 90 days. Okay, they can be any arbitrary period of time. At the end of 90 days, the algorithm checks: are you in the positive? Are you in the negative? If you're in the positive, we leave you alone. You just get a new period. Okay, you're in the negative. Then we ask, have you rebalanced to zero once at least within the last 3 months? Yes, the answer is yes. We leave you alone. You go, you continue to another 90 days. If the answer is no, then we ask, did you comply with the ITD rule, the income to debt rule? That means, in what proportion does your average daily income stand to your outstanding balance at the end of the credit period? If I end my 90 days with a $30 debt, okay, and my average daily income, I take all the incoming funds to my account, yes, and I average them out over 90 days. If they are $1, then my 30 days are okay. Okay, I need to be in a situation where I potentially could pay my outstanding balance in another month with my average daily income, which doesn't mean that I really have to do it. Okay, it can go further into that. It doesn't matter. This measure ensures that there is mutuality, that the money flows, and it doesn't go only in one direction. This is what it does. We don't care. As we said, like, that is good. Okay, so we don't care if you always in the negative. If you're always in the negative, this just means someone else is always in the positive, and it's fine. What we care about is that the money circulates. Exactly. So yeah, and if you fail to comply with that, you have 30 days to get yourself there. You have a grace period, and your credit line contracts to the size that to a value that would have complied with the ITD. So this way, the credit lines automatically expand and adjust, expand and contract, and we have the maximum amount of liquidity and the minimum amount of risk in the network. And if you don't comply with that, then you're considered as a defaulter and you're kicked out of the system. This is what happens. Now, technically, the cooperative running this could sue you. Yes, probably won't do that. Yes, in most cases, I suppose that there are many things that could be done. Your name could be listed on a list of naughty people, or you could be publicly shamed or whatever. There have to be some consequences. Otherwise, your money is only as real as your debt is. So if there are no consequences at all, if you're not kicked out of the system, for example, on non-compliance on like 4 different levels, then the system will collapse. And this way, we like the people that fail all these criteria are people who are not people that are in trouble. These are people who try to defraud the system, basically. If you just take, you never make any attempts, even at paying back, then the system just weeds you out. The reserve takes care of that, it's covered, and we're better off now because we have a better system with more trustable members.
Say on that.
Excuse me?
Can I come in on that point?
Yes, please.
Having been involved in sort of let schemes in the past and mutual credit now, is one of the reasons people join is because they have a hard time operating in the fiat system and this description of people defaulting as people who are cheaters is not my experience of
No,
many
no,
people
this
that
is just
join.
after
well,
this flow chart. I mean,
yeah, but after the flow chart, I mean, if Mario didn't die, but his mother got put in the hospital and he lost his job and he's a full-time carer, then in a mutual credit, which doesn't have so much computer says no possibility. I mean, I look at this and I just think pitchforks outside the person who coded this. You know, like my children are hungry, change the algorithm now, please. I
yeah,
always
but
worry
by the
about that
way,
problem.
this is run not by this whole everything we just detailed runs on automat unless a human intervenes.
Yeah.
And the system is built to be run by a cooperative.
So this is my question. The mutuality consists in the governance of these algorithms, and my question is how, you know, so many blockchain things, these algorithms are smart contracts.
No, the smart contracts are involved.
This is more addressable
No.
than a smart contract.
First of all, even if they are smart contracts, it doesn't mean that you know, you can't do anything to intervene. You can design them in ways that are completely mutable.
This is my question, really. You know,
Yeah.
how
Everything is absolutely
mutualized is the
mutable,
governance? Right, cool.
And we'll see that in a moment. We have.
Thank you.
Here to be the presentation. Where's the presentation? The thing, the video. Okay.
Yeah, so this is just the system with its parameters. If you were going to use it, you could, for example, say there's a social function where someone comes to the organizers of the co-op and they say, I'm having this issue, and there's a process for that and freezing their credit line, for example. So there's not like one entity that's running this one protocol behind the scenes. It's an implementation that you get to choose.
Another thing, like this protocol was designed with would call it like kind of like flexibility and modality in mind. It means it can serve a commercial function where the members of these networks are businesses and that do business with each other. It's just commercial credit clearing, in which case we need to be tougher. Yes, these are big boys. Or it could be used as a let system as well, and then it could be way softer, because defaults don't really matter that much. Even if the reserve is exhausted and you have a default, okay, you get some inflation, so what? There are all kinds of things you could do. We could, for example, even if the reserve is empty, okay, then you levy a temporary a transaction fee in stable credits until you like clear that. And inflation is not always that bad, and the market can reabsorb it, and everything is fine. Yes, but it's set up in such a way that if you do nothing, the system tries to find its way to like economic equilibrium. It doesn't mean like I'm not part of the club who thinks that market forces are the sole organizing principle of a human society, but they exist. Let's see. That's Bridger. Yeah, maybe. Okay, because it's shit. I think we'll just do it. Okay.
No, we got it.
Okay, so this is the and in the future it will look nicer. This is just this is the operator panel where the operator, whoever it is, representative or cooperative, a for-profit entrepreneur, whoever that is, a DAO. What? Zoom in. Okay, does this, okay, no, this doesn't, okay, never mind. So yeah, we have all, what you see there, the RTD, let's start with this. This is the reserve, okay? RTD means reserve to debt ratio, okay? And it has a target, okay? If our algorithms predict that there is a 20% default rate, the RTD tries to reach 20%, okay? And it does so with, again, with transaction fees. The moment it gets to 20%, yes, we still collect transaction fees, but we can return them. To whom? Depends on who we are. Like they can flow back to members who have paid the most transaction fees in the past. They can flow into a pool that we use to give fiat loans or grants to members or whatever, or they could be revenue of an operator if they're if that's the case. And here we have the metrics, the total supply, that's basically the total amount of data, the total amount of resource dollars in circulation here. Network that this is, these are past defaults that have been written off to the network. Here on this side, here we see, okay, that's technicalities. This is how the blockchain works, because it doesn't automatically, you have to click a button for things to work sometimes. That's, I don't know. So you need to hit distribute, and then this stuff will end up in the reserve eventually, but that's just technicalities. Base fee, I haven't told you, yes, but we have transaction fees that capture risk, and there's another transaction fee which is flat and fixed for everyone, which is smaller. And the idea is that the flat one covers overhead of the network, and the individual one covers risk. So, and if this means that if we see we run into problems, we don't have enough funds to run the network, like I don't know, maybe there are employees that need to be paid and so on. So we don't strap that on the risk. The risk part stays clean and as small as possible, and we play around with the base fee in order to do that. And also the risk fee is only paid by the people who deepen their debt position, and the flat fee is paid by everyone for usage of the network. So we have like the most cost-effective maybe arrangement. No, sorry. How do you do that? How do you go back? Sorry about that.
Maybe just let it play.
Okay. Yeah, it will take forever. Yeah, okay, he does that now. Okay, here he shows how you you can override the algorithms. This is what we talked. You can override algorithms and give manual credit limits and credit length and grace periods and the fee rate. You can, if you want, you can adjust everything manually. So you don't live under the dictatorship of a smart contract to yeah, that's from the operator's position. The operator is a specific role in the protocol, and again, it doesn't need to be a human. It could be a collective. It's just from the perspective of the blockchain, it's just an address. There is an admin function which works more on the protocol level, which never mind. Which has more like tech. It's like more like a service thing. It's us for the time being for networks. Like it's our ability to solve problems from afar. This is how a wallet looks like. Oh God, Jesus Christ! Sorry about that. I mean, okay, it's not that important. I mean, you can skip it. What do you think, Jessie? Do you want to? Okay. This is how the wallet looks like. And you can see how it looks like. And you can see, okay, how much, okay, now he shows how defaults work.
You just point.
Okay. Okay. Yeah, he did things and things changed, and okay, convert credits. What is this now?
This is sending your credits to cover network.
Okay, yeah. So it's like it's a cashback. Okay, what you saw is cashback. Someone defaulted. You can see amount of default increased to 1, and then it's basically just a demonstration of what we. Yeah, make a payment. If you for example, you don't need to default. Like if I get to the end of a credit period and I'm more or less in compliance, but I'm just a short distance away from being in complete good standing, instead of having my credit line contract, because this is what would happen. There are no other there are no other consequences. In order to prevent that, I can make a payment and pay in stable coin in fiat. Only the small amount that is needed to yeah, and now lots of stuff ended up in the reserve, and it's the excess, and like the operator is very happy, and that's it basically. Yeah. Okay, thank you.
Yeah, I was going to say we're going to switch to talk more about what this means practically for who we're working with. But before we go there, I think we should take questions more on the protocol side. Well, let's start with him, actually. Or him.
That's okay. So, do you have users yet of the system? It looks really interesting when well designed. I'm wondering if you have communities that have started using it.
Everything that has to do with the real world, that's actually.
Well, I'm gonna go into that next. So yeah, that's what we're gonna talk about next. Anything else though on like the protocol side before? Yeah.
More question. You said that your algorithms try to predict risks so that to adjust accordingly. What's your thoughts in terms of black swan or very unpredictable events that disrupt all the players?
The thought is that they exist, and the nature of black swan events is that they are black swan events, that you cannot predict them. Again, the worst thing that happens is that more people than you've predicted default, and then your reserve gets depleted. And then at some point you have an inflation in the amount of stable credits, and which is not the end of the world. Most mutual credit networks don't have that at all, and that means that so our insurance did not work optimally, but it worked to some degree, and it can be healed in the future. And there are certain things you can do. You can if you really need, you could demurrage. If you really need, you could apply transaction fee. You can do all kinds of things, but in contrast to the worst cost is inflation. That's the worst cost, basically, or the lack of and the entire network could fall apart. I mean, if everyone who owes something decides collectively to leave the network, and you have only people left with a positive balance, well, they're bag holders essentially. That can happen. It's very unlikely, but yes, life is risky.
Can users affect their risk percentage, the individualized one? I know they can affect their credit limit, but can they do anything to change what their rate is on risk?
That you mean their transaction fee?
Yeah, the individualized one.
Well, first of all, the algorithm that calculates that has all kinds of things flowing into it. One of them is reputation.
Can the users gamify it? Is that part of the game system?
If you're a new user, no one knows you, transaction fee will be relatively high. You're in the system, you transact, you demonstrate mutual activity and mutuality, and then your transaction fee, the next credit, you're treated every 90 days, by the way, and every end of credit period. So your behavior drives your transaction fee. In that sense, it will go down, it will go down. And if you are very close to default and your credit limit already contracts and so on, it may go up also.
I have a question. You said that fees are in hard currency, in fiat or in stable coins, correct? What is the envisioned ratio between mutual credit part and in the system and the stable coins or fiat? What is 5%, 10% envisioned slash
What do you mean by ratio?
Well,
what do you mean by ratio?
Well, you have a turnover of I don't know how much mutual credit, like 1 million mutual credit issued and played with, traded, On each trade of the mutual credit, you have percentage of the fiat currency.
The transaction fee.
Yeah, transaction fee. So what is the amount? And then this transaction fee goes into the
Reserve.
pool. Into the pool. So what is the amount, statistical ratio between the amount of the fiat that you have in the system that people are paying, and it is in the
You're
pool?
talking about the reserve target, what we call the RTD.
Yeah.
Well, this is you take basically what you do. It's a bit more complicated than that. You take every member has a risk score, which is like from which we deduce the transaction fee. Okay, we can take all these risk scores and do an aggregate, like a kind of like, if you will, weighted average, depending on their impact on the system and how much risk they introduce. Yes, and we add on that some a correlative risk, like what the correlations between members is. Like one defaults, it means that actually 10 will default. We add that on top of that, so you get a number. Okay, let's say the number is 15%. It's 20%. Yes, that means that your RTD, your reserve to debt target, is 20%. That means that the reserve will collect transaction fees and withhold them until you reach 20% of outstanding debt. That means basically the token supply. The moment you exceed that, the incoming transaction fees flow back to the community.
Thanks. First thing I want to say is big props. That is a really serious piece of work, and it looks very, very carefully thought through. And having been in mutual credit circles for a long time, the idea of the algorithm that you showed us for the default, many people have talked about it, many people have begun work on it. I have never seen anything as thorough and careful as that. So that is a real contribution to the world of mutual credit, and that's to be really recognized, I think. The thing that I was worried about, you've also thought about. I was sort of wondering where the mutuality was in that because of all this brilliant algorithm design. And you immediately said, no, the community can come together and make a social decision to extend a grace period or whatever. So this is all very, very nice. So again, thanks.
Very much.
What I'm wondering, so you put a huge amount of work in, you run the resource network, I'm wondering about, and it sounds as if you're imagining, bounded instances, a group of people come together, whether it's a US type IRTA network or it's a community cooperative or whatever, and they have a bounded instance, the rules are internal to them. Yeah. They are needing to somehow pay for the work that the resource network does in some way. And I'm wondering how that works. And I'm also wondering whether that also includes some way of different bounded networks coming into relation with each other. And I think those two possibly speak to the same mechanisms.
Sure. Yeah. Our thought is not every network operator wants to take on the complexity of managing this backend system themselves. And so, yes, there could be a fee baked in if, like, once the reserve reaches its target and out of the fees that the network operators can take to distribute amongst themselves or whatever they want to do, that our team is getting paid from that fee to basically run the risk management infrastructure.
It's basically, if you think about the open source model like Linux, everyone can use Linux, but Linux still get paid somehow. So it's kind of that.
And then, yeah, your second question. So we have not developed it, but we know that the next large push that we do on a protocol level is about inter-network trade. So sort of a clearinghouse for the different stable credit currencies. And that could be another thing that, we developed, and maybe there's a fee charge for using that system. Are you familiar with IRTA's clearinghouse system, right? It takes a long time to use. Members can't participate in it directly. Only network operators can. So we think there's a big opportunity in that, and it's really necessary for growth, but also very complex.
Yeah, we kind of have again, doing this is simple. The question is, how do you neutralize risk? And then we also have like a thing there with transaction fees and that kind of like do that, but that's yeah, but there are different things to take into account because yeah, I mean, if we at the end of the day maybe have some time, then maybe we will run through inter-network trade also.
All right, shall we move on to on-the-ground applications? All right. So this is more strategies in general, I think, for local currencies, community currencies that I wanted to talk about that, are not things that we've individually arrived at. I think a lot of projects have derived at them. So I want to go through how we're approaching that as a team, people that we're working with, and I'd also like to open that up for discussion at the end in terms of other people's perceptions on that, because we have a room of people who've been thinking about this problem for a while. So one of the things that I think is really important to bring up, where could these systems be most useful? So they could be very useful in places where people don't already have access to good functioning credit lines. So that's a huge focus for us. So places where it's really difficult to get an affordable credit line. So we're working a lot in Africa, and I'll talk about partners that we're working with there. The second thing that we've come into is fiat loans. So we have actually added fiat loans into the system. The reason is it's very difficult in terms of the educational nature that it takes for an average person to interact with these systems to start to trust that this is just money, as you say. So we've actually designed in fiat components, and we'll talk about how that works. We're also working with existing barter and trade networks, right, who already have some sort of mutual credit currency, some sort of local currency. They want to introduce the risk management system. So that's another thing that we're working on. And then I'll talk about an employee benefits go-to-market strategy. So just to talk about the situation today in terms of where the financial system is not as developed, and we all not talking about the reasons why that's the case, but the actual reality for a lot of people is there's not enough money to go around. There's not enough credit to go around. It's very difficult to get a small business started. That's the reality for billions of people across the planet. So we think that the focus of mutual credit can be something that really helps address this problem, not just on the mutual credit side, but also as a credit building tool, financial inclusion tool that can also then open up other opportunities to other systems that exist out there. So this diagram just shows the situation that's going on in lots of places around the world, where you have this cyclical spiral of underemployment, low effective demand for services because you are not able to start these businesses, very expensive and extractive credit options, right? Like it's common to see something like 100% interest in a lot of places around the world, and that's compounding interest. It's very difficult to get out of that situation. So we think that, as a community of people that are working on these projects, this is a huge focus for what we can be doing today to solve the problems, rather than worrying about, how do I convince someone in a small community who already has a working financial system how to accept these currencies. We can actually go where the problems are very real. So in places where there isn't a well-functioning financial system, I'm sure many of you have encountered this, but just to highlight like where we're working in Kenya, it's possible that someone who you meet on the street, up to 70% of their income that month is coming from sort of an informal source, right? Like an IOU with a family member, a friend, a store, the school. Up to 70% is average, right? So what does that mean? That means that already there's a whole informal economy that's existing for billions of people across the planet that could really benefit from some of these tools that we're developing. So these are the things that we're focusing on right now with our networks. We're also going to talk about how to seed networks with fiat loans. This is something that could work in many places around the world. So basically the way it works, we designed a smart contract that's called a launch pool. So you can imagine you're in a local community. Let's say we're in Hudson Valley. You go up and you get 25 different businesses on board. And you say, hey, if you guys join this network, you're going to get underwritten. We're going to go then sell gift cards to the larger community at a discount. If we reach a certain amount, you'll receive a fiat loan. Now you can use that to buy your commercial dishwasher. Maybe you need to pay staff this month, whatever it is. And all you have to do is now pay that back by accepting credits from people who bought that gift card within the community. So what you did there is basically bootstrapped a network where now you have businesses that said, well, yes, this is a great deal just to participate because it's a fiat loan at very good terms where I'm getting new customers. And at the same time, you created a scenario where people are now understanding how these alternative currencies are actually a different form of money. So we think this, we're packaging this into a tool right now, and that's what we're going to focus on in terms of how can people just get a network started in their community. This is a really good package for getting that going. Any questions on that? Oh yeah.
Except like the educational part, the moment you've done that and you sold these gift cards, you have all these businesses that already have that, but there's only that. They don't have liquidity. Now, if you underwrite new members, they already find themselves in a situation where they can spend their credits immediately because they have received the fiat loans. And the customers, they will take their time. They will like recirculate after a while. But
we've also designed that into a revolving credit pool contract. So there's sort of two scenarios where fiat loans enter our system. One is that launch pool, we want to get things going. Another is you can just have a revolving credit pool contract. And I think you can imagine a scenario like a local town where you have people that are living there that don't necessarily own a business, but they want to support their local economy. So they're basically buying these gift cards at a discount, which is providing the credit going to the businesses. So that's something that we could see being used in a lot of different scenarios. All right, so to talk about, so are people using this? So where we are today, everything that Julian discussed, that's all built, it lives on the blockchain. We launched it first on the Celo blockchain. We're currently building our SDK, which is gonna make it possible for now, for example, an existing barter and trade network to integrate the resource protocol. So we'll probably be finished with that in 2 months. It's basically an interface to the protocol that makes it so if you wanted to integrate it into the current, you don't have to know how to talk to the blockchain protocol. You can use, yeah. It just makes it much easier to develop on, basically. So once we finish that, we're going to be focusing on our partners that we're working with mostly in Africa for the reasons that I described before. I think the need is just so much stronger there. And at the same time, it's an SDK, so other people will be able to start to play around with it and work with it. Maybe not right away in 2 months, but we'll get there. So just to talk about some of the people we're working with. So this group is called Fresh Life. They build toilets and install them in informal settlements. So what you see behind them is a toilet. And then they have franchise toilet operators. So the people you see there are basically staff that come and also collect the waste from the toilet and they turn it into organic fertilizer. So they take the waste from the toilets plus waste from all around greater Nairobi area and also across Kenya and turn that into organic fertilizer that then is being sold to farmers. So they're a pretty big operation. They've been around for over a decade. They service like 400,000 people a day with the toilets across Kenya. So these are the types of people that we're working with who are social enterprises, NGOs, working in these types of environments where they've already kind of established trust in an existing community. That's another thing that we've ran into in this type of work, right? As a lot of you know, building these communities from the ground up, it's a lot of work because you're building relationships and relationships take time. People need to trust you. They need to trust the technology you're bringing, all those types of things. So our strategy is really working with partners, people who have established trust in various different ways. So this is a group that we'll be working with, starting within Nairobi in August or September to start a network. This is a group in South Africa, so they're called South Africa Harvest. They've also been around for a decade. They've delivered more than 30 million meals across South Africa. So what they do is find food that would otherwise go to waste from farms and things like this. They have refrigerated trucks that then bring that to soup kitchens and places like that all across the country. So they're very interested in this system for two reasons. One, they see that they're constantly providing food as a handout and the relationship sort of ends there. So they see this as an opportunity to actually involve people in a productive system. So the pilot we're designing with them is basically finding a old farm, like there's an old tea plantation, for example, reactivating that by providing the mutual credit currency as a payment for labor to reactivate the farm and basically start producing food. So they're very interested in that in terms of creating jobs for the people that they're serving already. And then similarly, they're nonprofits. So they're interested in how can we as an organization create more sustainable operation impacts for ourselves as an organization. So we're not purely relying on donor dollars. So we think that's a model that could be used, over and over again too. Sure. Yeah. So in this instance, they're playing the role of the network operator. Another way to think about it, both of these are NGOs or social enterprises. So probably more what the model will be is taking funds that they're getting from donors and basically amplifying the value of those funds by doing these economic development projects. So that's kind of a high level. In a simple way to say, there is going to be a transaction fee charged in the system that covers the cost of what they're doing. They could choose, though, to have donor funds subsidize that. Something else we're really excited about is universal basic income as sort of like a first, how would I say, like kickstarting financial systems, right? So this is a group called Impact Market that we're working with. They have a group of mostly female entrepreneurs in Uganda that have been receiving UBI, that's donor-funded funds. So we're working with them to say, okay, now that you've built a community that's receiving UBI, what does it look like to introduce a mutual credit network with the community that you built? And we think that's a repeatable package that could be used for working, especially in emerging markets. Sure. So the UBI component? Yeah, so that's like a separate system and that's their project. So yes, they raise donor funds and they deploy that as just a normal like fiat currency or digital fiat currency, if you will. So then we're just working with them to basically say introducing the complementary currency on top of that system. Yeah. Cool. Yeah, I'll look into that. Yeah, and the last thing, I mean, this is just an example of, there's a lot of other softwares out there that exist. A lot of you guys have built these softwares that are already running barter and trade networks. So we also just see this something that could be easily integrated in these tools that are already there and start to learn what that looks like for the existing barter and trade industry. So with that, we are going to go to Matt to talk about the existing barter and trade industry that exists, but anything else like questions wise for us before we go to that? All righty, thank you. Yeah, sorry, I'm just pulling this up for you. You don't want this?
So just for completeness, I want to say what I know about the existing business barter industry, because it's in the mutual credit section and it's quite sizable at the moment. And I did ask several people from the industry to come to the conference, but none of them thought it was a high enough priority compared to all the other things they were doing. So they're not represented here. I also asked the international Reciprocal Trade Association if they would come, but they were busy as well. So it's just up to me to summarize that industry for you so you know what's going on. It's been around about 20 years when the business barter exchanges in North America mostly got together because they needed to work with the law around the taxation and things. So they made the International Reciprocal Trade Association as a way of lobbying or interacting with the government. And there are now several hundreds of members of local trade exchanges. Each one is a kind of mom and pop shop, although there are some larger networks as well. And what they do is they recruit members into their ledger and they encourage them to trade with each other, very much in the same model as Sardex. Pepe has just left the room. I think he's not very happy with the whole IRTA official business barter scene. I asked him to come and help me with it, but he said, these guys they're just dead. We are the new thing. So with that in mind, I'm just summarizing for you what has been. So these mom and pop business barter shops, they're constrained by law and finance to charge membership fees in fiat dollars and also transaction fees in fiat dollars. And all of this really slows down the incentives for doing trade. They also only appeal to a certain sector of the economy. And you can see that in how it's marketed. They talk about surplus, I've forgotten the word now. Does anyone know the language they use? Spare capacity, surplus capacity trading. And that means they're appealing to organizations like cinemas and restaurants who have a fixed capacity, but it might not always be full. So they've got 500 seats, but only 300 people sitting in them. It costs them zero to make those seats available. But if they can get in exchange not fiat dollars, but barter dollars, then that's better than nothing. And so those kinds of industries that have surplus capacity are the biggest users of the business barter exchanges. But perhaps arguably they don't gain very much because of the high membership costs and the high transaction fees, which have to be paid in dollars according to the law. And so this is something we need to be aware of if we want to build networks of ordinary businesses. They're quite restricted in legal terms. I'm not an expert about that at all. On the software front, these many hundreds, maybe thousands of local businesses are supported by a handful of software offerings, which are made by software companies that generally specialize in making one piece of software. And those software companies are looking to capture the market. This is not solidarity economy, even if you like the mutual credit mechanism. So they're looking to get exchanges to use their software, and they do that with the best features and the nice parts of capitalism, which encourage us to do our best. But then they also want to build a network and enclose the network so that they can take the transaction fees happening between the different instances of their software. So if you're a business barter exchange and you've got all your members, you can offer them the possibility to trade with the other users of the same software in different exchanges in different parts of the country. And Bartercard is doing this, and there are several others. So that sets up a situation in the industry where you've got this constant tension and war between the different software houses who are competing for members. And that doesn't benefit the members, except in terms of them having better features in the software, but it doesn't increase the marketplace and the range of goods and services available for them to exchange, because it actually draws walls between them. They're locked in by the software vendors, as we know happens in so many other industries. So that's all I really wanted to say about that sector, because that's all I really know. I think it's a situation that needs to be broken somehow with imaginative business thinking. I'm going to talk when I'm queued about the Credit Commons, which is one way that maybe that could be broken. Shall I go into that now?
Can I ask one question about this software?
Yes.
Because Resource is open source, right?
Yes.
So how do you pay the developers?
As we said earlier, like our model is an open source model. It means that the software is free to use, but we charge for implementation fees. Basically, the same thing Linux does. Where do our current funds come from? Like who paid for the plane ticket to get us here? It's again an Ashley question.
What was the question? Oh, who paid for the plane ticket? Yeah, so we had investors, and the investors basically will receive some sort of proportion of our team's implementation fees in the future.
And is it also so what Matt just said about these software companies are competing to get the market? Is that also how you experience it? And you need to lock
Our dream is, yes, to turn this into an industry standard. So it's like because there's interoperability. Like to be completely honest, even in our case, networks will not be locked because again it's open source. But if we talk about internetwork trade, yes, we haven't figured out how we can facilitate trade with networks that run on non-open source software that we cannot interface with, obviously.
So let's start the quick Credit Commons presentation, if you can turn the screen on. Yes. So slight change of plan. This is going to be a shorter session than all the other morning sessions. And before lunch, we're going to have a presentation from Ethic Hub. Where to start? Well, there we are on the question of how do you trade between different groups. And the Credit Commons is, as I said in the introduction, if mutual credit is a kind of ideal, the Credit Commons is an extension of that ideal to make it scalable, recursively scalable. And it's just a protocol that any exchange could use to trade with any other exchange. I want to quickly talk you through the visual language, and then we'll run through a couple of other things. It'll be very fast, and then you can ask to see more if you want afterwards. But this will give you an idea of what the Credit Commons protocol is, and I don't want to take much of your time. So because we've changed format, we've lost the end of the people's names, but that's Alice and Bob with a balance of 0. You can move on. And this is what happens when they do a trade. You can see one balance goes up and one balance goes down. Area of the bars above is the same as the area of bars below, which means that credit equals debt, which means that the total balance is 0. We could do 2 or 3 more trades. The area below is the same. Can you advance and advance and advance? So, no, we'll just go past that. So what happens if you want 2 groups to exchange? What happens is you make a virtual account. You make an account for Group B in Group 1. I apologize for the floating bar. All the bars should be on the line. It's just a file format problem. An account for Group B in Group A, an account for Group A in Group B, and they correspond. They have to have the same balance. The orange bars have to add up to 0 as well. In fact, this orange bar should be below the line, right? And the next. If you had 4 groups and they were all doing this kind of bilateral exchange, each group would have 1 account for each. And then it starts to get complicated. What we do instead is we make a meta group, which is the one below, and then all of those other group accounts are mirrored in the meta group instead of being mirrored multiple times with each other. So that's a sort of factoring out. And the balances in the meta group all add up to 0. That's another floating bar, isn't it? And still the balances in each individual group all add up to 0. That's because the oranges correspond with each other. What's above in group A should be below the line below here. I got this point, especially for this. So that above the line corresponds to that which should be below the line, and everything balances out. So you know that the system is integral because everything balances out. But actually, these are separate on separate computers running separate software, but communicating through the same Credit Commons protocol. Next, please. And so the system is recursive, it can nest, and this is showing 3 layers. I've named them. So if you think of the leaves as individual accounts, then you can have twigs, which is the exchanges on the outermost reach of the tree, branches which connect the twigs together, and there's always a trunk at the bottom. And the Credit Commons protocol describes that relationship. And with that, you build the whole tree. Next. So we could go very quickly through what the Credit Commons protocol is doing. I want to stress that this is all built, at least in a reference implementation, and it's being used in mutual credit service projects. So here's your experience on the phone. You're Group A Alice. You want to pay 10 Alice units or units of your own exchange to Group B Bill. And notice the addressing system. The Group A Alice, Group A is Alice's group, and it's just like a path in a file system because that's how you address things in a tree. Next. So there's Alice's ledger. The phone is talking to the ledger. Next. The ledger sets up these 2 transactions. Note that this one, which is perfectly above the line, should actually be below. That's just awkward, lined up. The software needs to do these 3 things, and then it relays it to the trunk, where those 2 bars are replicated and checked, and then it's relayed to Group B. Group B confirms the transaction and validates it, sends the message back, which is confirmed. There's a hash function going on here. That's what the hash X and Y is, to ensure that those 2 ledgers are the same and that these 2 ledgers correspond. And next. And then that transaction is confirmed over here, and it goes back to the phone, and the phone sends a OK. So that's the simplest possible thing that the protocol is doing. And next, this is another view of what's happening. Can you just click through about 3 seconds each slide? People can get the idea. Can you stop? Another thing that's happening here is that the initial transaction of Alice to Bob, to Bill, is being, there are more transactions being added by each ledger. So it's like a transaction fee per ledger, and they're all clustered together and validated together. And that's the last slide, is it? Okay, so I just wanted to talk you through how it goes from the phone across the ledgers and back to the phone again. So all that's working. And I don't need to say much more for you to understand this is how we would ideally network together using mutual credit in a recursive structure. So I offer that to the community. And you'll hear a bit more about it from Dill tomorrow. The day after. It's tomorrow, isn't it? Saturday. Tomorrow is local vouchers. So it's time to go for a break, or do we want a bit more questions? We have a question over there. Is there a... Thanks, Dill.
One of the questions for these credit clearing protocols always will be how to make sure that the distributed transaction was atomic. And so to preserve the integrity in the network, because we have all these fragile points of connection in which like the message might be sent, the account balances will change, but not all accounts change. So is there anything in the common protocols that addresses, confirms?
It's the hash function. The hash exists between each ledger connection. So when I showed you the link from a parent to a child, that means that the account at each end has to be the same, and there's a hash being built to check it's the same.
So all the nodes in the network that were part of the clearing, the transaction that clears the credit, the bilateral credit circuit, sign each other's hashes messages, or that only happens at the intersection of two peers?
Yes, it only happens at the intersection of two peers because the protocol does not control what happens inside any one node.
Yes, for sure. But is there any record trail that, because there are more than two peers involved in credit clearing, that basically verifies or attests that
the transaction is written on every ledger?
Yeah, but is there anything that keeps record that of not only the parts, but where the whole network acknowledges that it has seen the change in state?
You would have to traverse the network to find the transaction on each ledger and see that they were the same.
After the fact, as an accountability practice. Okay, that was the question.
Okay.
I can add to that. The protocol is deliberately designed so that, in fact, the trunk can't look leafward. So if you wanted to validate everything after the fact across the whole network, you would have to have the consent of the leaves at both ends to be able to. So this is, so in other contexts, I've talked about the possibility of an information asymmetry being built up by a privileged partner, and this leading to a structural implication that something like a bank is likely to arise. This network is designed to delete that at the structural level. If you want an overview of the whole economy, you have to get the percent of everyone involved. So it's not the trunk can see, the leaves can see right up to the trunk because they have delegated membership all the way to the trunk. So if I'm in a leaf, I can validate my half of the transaction. I can request towards the trunk to see that everything went through. If I phone up my counterparty, they can do the same and we can compare notes. Yeah.
So yes, that's like at the same decision. And the issue I was trying to get in there is reputation. Transaction reputation. So basically, is there a trail that can be held accountable, everyone in the network, against like transaction reputation, which it will be like credit clearing?
No, there's deliberately not a whole network panopticon. Deliberately not.
There's no reputation, it's pure accounting. And another way to say what Dil said is that each node is a private organization that controls what can be seen within it. And you don't need to know much about someone in a node, in another node, in another node, in order to be able to trade with them. You just need to address them, and they have to have the right, they have to have the capacity in their account to pay or to receive within their balance limits, that's all.
So if you consider it as an open network, then you don't need consensus across the whole ledger. You don't need consensus from people who are not party to the transaction. You do need confirmation among the parties who are party to the transaction. And that is actually theoretically impossible due to the two generals problem. Because if I send you a message saying, this is what I think happened, and you send me a message, yeah, this is what I think happened, you can never get complete information if these messages might get lost. But you can keep sending messages so that you know at least, well, the latest information that I received from you matches my internal state. I don't know if your current internal state is different because I may not have seen the message. But yeah, just doing one-to-one messages between the parties to the transaction, and if you keep sending them, then eventually you will get full a common knowledge between them. Even though it's you still have the two generals.
I just wanted to say this is a structure of credit. Right, so shall we go for B?
Well, if there's no more questions, I'd just like to say something which we've been talking about recently. If you look at, and this is the perfect slide, this is one way to look at this is an aggregating of stable coins. So Resource talked about insurance. In mutual terms, I think the term assurance is more appropriate. These are peers coming together to assure the value of their network. Insurance suggests a third party, but that's just semantics. But here in this network, the assurance is much clearer. The members of the Leaf networks come together, they share a single balance of trade account with the wider context. That the number that they represent, and by the way, they get to choose their own exchange rate. So they basically set their prices with respect to the network. There's no Forex market here. So it's marketing. So they are declaring a stable coin in a wider context. And of course, a stable coin of, a neighborhood might be not considered very stable. So then they join together into a town, and that town declares a stable coin into a regional network, assured by the diversity of the members of the members. And as you go towards the trunk, the sort of volatility is decreased, and the number of assurers of the value of that coin, the diversity behind it, if Mario dies, you don't really notice when you've abstracted a few steps away.
So each ledger has a unit of account, which you call a currency, if you like, and then each Leafwood node on the ledger has an exchange rate with respect to the Trunkwood node, and they can adjust that by whatever means. I would recommend consent and governance, but you could also set up more automated ways of managing the exchange rate according to the balance of trade. We done? I imagine and hope that some people would be interested in looking at this presentation in more detail, so I'll send it to you if you send me a note.
we are going to start because they want to give a walk afterwards, right? Yeah, and will be a short presentation about what we are doing with EthiHub and how we can collaborate with other protocols. We are already in talks with grassroots economics and with Resource for sure. I have been with Ashley for a long time talking about we integrate in some way. At the end, as I see the financial system is 90-something% is the TradFi financial system and so on. We still have to do things leveraging on them, bring capital from them to the community, local communities with alternative currencies. That for sure is what we have to move forward. But this is not our project. We are not creating mutual credit nor local currency, nothing like that. What we are doing is helping those communities who has a local currency or not connect with lenders and capital worldwide with harder money. Because at the end, the communities in grassroots economics or in Resource, these guys in Kenya, at some point you need more than your local currency to buy a computer or something else, right? So you need some form of bringing capital from where it is more abundant, normally in developed economies, to where it is more scarce in the developing economies, which is what we do in EthiHub.
So to start, we started with the problem, not with the technology. We were lucky enough as to be part of that system. I worked for the Secretary of Economic Development in Mexico, in Chiapas, and I was also an organic coffee producer. So we started with some farmers that were our neighbors, asking them what the problem is. And so regarding the global financial, the traditional financial system, what's the worst dysfunction? Since our point of view is that it left excluded 1 out of every 4 human beings, 2 billion people. For having access to working capital, they have to pay over 100% interest for the little money they can find within their communities. And from these 2 billion people, 70% are smallholder farmers living in poverty despite producing more than 1/3 of the food of the world, our food. And it's amazing and it's terrible because they live in some of the greenest and most vulnerable areas of the planet. So their well-being is ours. And you jump too fast from there. Yes, and this is called the poverty cycle. Because of the money they can get is so scarce and so expensive, they cannot invest into improving their productivity to break free out of this circle. So we start by doing arbitrage between complementary economic regions. So in Europe, we have even negative rates. So we connect you with them in this crowd lending to provide affordable working capital. But then we realize that it's not only the scarcity of the money because they are physically far away from the cities, but especially because they don't have eligible collateral to ask for a loan in the traditional system. And a lot of people think this is solved by microfinancial institutions. It is not. I learned that rural doesn't mean agricultural. Rural means small areas, small communities, but not rural. Because for a microfinance loan, you have to pay every week or every month. And if you have a year-long cycle as coffee, you need to borrow. And if the only borrower is the shark loan that gives you these small amounts, you never break free of this. So this is a huge problem. The World Bank says it's almost $1 trillion. Problem and opportunity. So there's a wide range of possibilities to reach them in a regenerative way, not an extractive economy, but generating more value than the one that is extracted. And here is where blockchain kicks in. So with the money is a vehicle for well-being, and the current system is preventing all these people from this well-being. And we can contribute to change this just on the decisions we make when we buy food. So check out who do you buy the food from and where do you buy it? Because these are two different ways of producing coffee. This is how 80% of the coffee in the world is produced. The smallholder farmers that are excluded from the financial system produce 80% of the coffee. But then we have the flatlands that there are in Brazil where everything is mechanized. So this is just a hint of how it impacts the environment, the social, and the economical part of it. Of course, the first producer of coffee in the world is Brazil, which has these flatlands in the height, the appropriate height, and 80% of the production is with people that has only 2 hectares. So the point is that they are too small to access the financial system, they are too small to access a traditional certification system, and they are too small to access the carbon credit benefits or biological services or anything. All this is designed for the other 3/4 of the world. So they remain excluded, and we think blockchain shouldn't be another way of exclusion. So we found the ways to make them benefit from the Web3 world without necessarily interacting in this stage. We will explain that a bit later. So as I was explaining, of course, it's a huge business. So of course, there are a lot of fintech trying to solve it. But the current approach for the unbanked is based on credit scoring based on data. But these farmers don't have Wi-Fi, don't have connectivity, so they are not eligible for that. And the other one is based on assets. But as I said, these 2 hectares of land are too small to be considered valid assets. So for this precise profile of excluded farmer, we designed something that we call crowd collateral. That it is a tokenized blended finance, if you want to consider this, where third parties stake collateral on behalf of the loans of the farmers. So you can catalyze, you can attract impact investing because you are providing a means to support the loans. And here's something very important about lack of knowledge. Most of the farmers in long term, I'm not talking about microfinance default, but default from these farmers is less than 3%, but people doesn't know it. So we need to give you comfort that there is something backing the loans for you to be willing to invest into them.
Yeah, so there is basically 4 stakeholders. This is also helpful for the ones who want to join this afternoon about the tokenomics, how to improve the tokenomics of the Ethic Hub, of the ethics, which is our token. And ethics is for the collateral. So you can become a collateral provider by buying ethics and staking on behalf of the loan originators, which are normally the cooperatives of smallholder farmers, or other entities working with those smallholder farmers. And then you can also take the other side of the equation, which is providing them with loans, loans in stable coins. So if you take this position, you are covered by guys who took the other position. I don't know what's happening. And in the other side of the world, besides the loan originators, we work with auditors. Auditors are trusted entities who can provide due diligence to those cooperatives or entities working with the smallholder farmers, and they also have to have a skin in the game, so they have to stake ethics on behalf of the loan originator in exchange for a fee. The auditor business model is doing this searching of new loan originators, due diligence, and a stake in exchange for a fee. So here, in practice, this is a tuple system. One is the lending pool made of stablecoins, where the cooperatives borrow stablecoins, and the compensation system made of ethics. So if there is any default, ethics are sold to cover for those defaults. But the important part of it is, as you want to be covered by the compensation system, that means you have to pay for the insurance. That means in our case, 4% of your money goes to buy back ethics from the market to further capitalize the compensation system. So as far as we have below 4% default, basically we are taking ethics out of the market to further capitalize the compensation system, which every successful loan, and as Gabi said before, the average is 3%. That's why we said the 4%. But as we are in early stage, we take super conservative approach to credit scoring, etc. We have only 1% default or even less. So the compensation system is, at the end, capitalized in 3 different ways. Is the fee in each loan. This is the sustainable demand for the ethics. And we have 2 extra demand drivers for the ethics, which is new loan originators have to have some skin in the game. That's the license. You want to access cheaper capital. That means you buy the license. That means you buy some ethics and a stake on your own behalf. Then the auditor who provided the due diligence has to have also skin in the game. And finally, you, as the community of Ethic Hub, provide the remaining collateral for the loans. And the end goal of this system is to create this incentive loop, because for me, the value of crypto and tokenomics is precisely to create incentive loops. In Bitcoin, it is about creating security for the network. Here, in a different way, is the same. The more demand, the more loans, the more demands for ethics. The more demands for ethics, the more secure is the compensation system. The more secure the compensation system, more people is willing to lend, and so on and so on. For sure, that's make the system very reflexive. But this is something that we think is good, not bad. And just to clarify, because afterwards, there are 3 auditors in the system. One auditor, the first auditor is ourselves as the equity company behind Ethic Hub, which main business model is buying and selling the coffee of those farmers. Then we have a second auditor for the lending protocol, which is Heifer International, which is a huge NGO working in tens of countries with hundreds of cooperatives. And the idea is that they will onboard all those cooperatives be lended through our lending protocol. And the third auditor we are working in right now is with a solar panels provider to the smallholder farmers. Because one thing Gabi didn't say is they are excluded from organic certifications because doing MRV is almost impossible if you have to drive 3 hours and walk 2 hours to arrive to that plot of land of 1 hectare to do the certification process. They are also excluded from the financial system, for sure. This is what we are trying to solve. And they are excluded from the grid, electric grid. It results that more than 1 billion people is excluded, still have electricity. Who they are, smallholder farmers in developing economies who are the same, who are excluded from the traditional financial system, who are the same, who are excluded from all kind of certificates and carbon credits market, because MRB is also excluding them from accessing traditional credit markets. So basically, this is Ethic Hub, and we invite you to join our community. You can do many things there, starting with buying a stake in ethics, lending to smallholder farmers. Now we are in a crowd equity round, so you can join that crowd equity partner, as we are talking here with grassroots economics and resource. And whatever questions.
To add something about numbers, we started with 42 farmers in Tapachula, in Chiapas. And that's when the Inter-American Bank for Development came to visit and talk to them if it was true what we were doing. And now we are serving over 600 families. Our platform using smart contracts has intermediated over $3 million in these microloans with less than 1% default. And even this small default has been covered by our compensation system. So today in the afternoon, we have the meeting with, thank you. And I think the challenge has been combining, as I was talking with some of you, this menu for vegans and carnivores, putting together Web3 crypto with impact space, because they are very conservatives. They want to do change. There is more money in the whole development system than in the whole Web3 space. So we have to connect all this funding, all these resources to drill down the bottom of the pyramid and bring there the resources, because they are meant for that. So we need to do a transition. A lot of you are working within Web3. We're working in the connection between Web2 and Web3 to make these things happen faster. And that's been the challenge, because a lot of crypto bros don't want to know anything about real life, nothing outside the algorithms and all the aseptic word of the mathematics. And if you talk them about poor farmers, they won't think there's something to do there in a way that is not donations. So I think that's something that it's a prejudice, that helping should be altruistic only. But then how do you bring the brightest mind to work on solving the hardest problems if you expect them to be volunteers 2 years and then they go back to their life? So we need to embed these solutions into a system that benefits all the stakeholders, not just getting this colonialistic approach. I'm going to help you. No, I'm going to connect you to the world that we are all together and do a better place for everyone, hopefully. Thank you. Questions?
It's not a question. Just thank you again for sponsoring us. It's the first time you come here to the hub physically, and so far you sponsored us on trust. So I hope we can continue, and now we'll get better now that you know the place. And I hope you enjoyed the commons.
A lot.
Yeah, I think. I mean, just a comment. I think it's very interesting that you are working on this inequality between like the capital in the West being cheaper to access and much more than in the global South. And I think this should be an element on which we base a lot of strategies on, because it's very mathematic and it's there, and there will be markets that will reduce that imbalance. And yeah, so I think for me is like the solid grounding that we have on the global economy and on processes that are there that we can work on, and to both solve the problems there and augment our collective power. So thank you.
Thank you. I think this is about collective power. That's the important thing. We come here to look for synergies with your projects, because if something is valuable about this technology is its composability. So regarding, for example, local currencies, community currencies, we don't want to build that. It's already built, so we can connect what we're doing with that. That's the intention, to exponentially synergic collaboration with other projects and with other ideas. Maybe we can, everything is improvable. We have built this closed loop with the financing and also the trading of the coffee to generate the incentives. Why the farmers pay? Because they are good people. Yes, of course. But why do they pay commercially? Because they don't have access to another source of affordable income, and because we open markets for them also. So it's a positive incentives loop, and we can improve it with other features that you are working with. So that's why we invite you to participate in this afternoon talking about our token. Do you have one question?
My question was, by the way, great presentation. What are some of the challenges that you face in terms of getting adoption from the different parties that want to participate and put skin in the game?
Well, I think the main challenge is skepticism, too good to be true. You know, I will give an example. We made a video of one of our lenders talking about why he invests and earn 8% annual return and this and that. And that increased the number of participants in our platform. And I thought it was a beautiful idea to record one of our farmers saying, thank you for investing in us without knowing us. Thank you for your trust. We did that. And we got a lot of bad things like scammers, thieves, you know, like why? Because we have the prejudice. You think a Spanish fintech can give you 8%, but this lack of knowledge of the other reality, you don't know this guy was paying 90%, 100% interest for the money. So you don't believe he's able to pay you 8%. So that's one of the lack of connection, as I say. We choose the name Ethic Hub because it means a connector. And when we choose the word ethic, it's not because we are like this proud of it, but it's a declaration of intention. It's where we want to go and who we want to go with. So maybe some companies want to approach us because of the name, you know, but it's something clear to state where we want to do it. So the challenge would be to connect. Because the farmers, as I got interviewed 2 days ago, and they were asking about this adoption. When the need is so deep, people move forward. They learn how to do the basic things they need to interact. Because the need is there, so that's your incentive to do it. So I think the most barrier for adoption comes in the, what's the word? Institutional side, you know, because all that money is meant to solve with the tool we develop. But there's a lot of skepticism regarding that. And for the technology, we all know we are in a very early stage and it's not user-friendly. The first 2 years, we almost lived in Mexico working with communities, and we try to connect them directly, to have a wallet for them, and they have to come to our office and connect with our computers, and that was not scalable. So we made a cooperative with all the farmers, and now the whole cooperative is one originator. So the legal representative has the wallet and manage all the funding and the conversion to local currency. We need to adapt with the existing things in order to have a better future, but I think in 1 or 2 years, it would be possible for the farmers to have mobile connectivity will arrive in time also there. So we expect in 1 or 2 years, they would be able to have kind of a wallet. So even when we still need the originator as a trust validator, Ethic Hub is about circles of trust, but we would be able to follow the funding up to the last beneficiary. And the same, we are working in and this I invite you also to join, we are working in a parallel project that is bringing also the benefits for them as the stewards of the land and all the services they are providing, and to be able to grab those benefits and fuel them back into them. We are working, we say, well, everybody knows, Web2 is about competitors, while Web3 it's about collaborators. So we are collaborating with Token Protocol and SolidWorks to figure out how to do it in a small scale, and they will help us with the commercial part of it once it's done. So you're very welcome to join to these efforts also.
So where are you with the crowdfunding campaign?
Sorry?
With the crowd equity campaign, where are you at with that?
Thank you for asking. Okay, obviously we still need investing to move forward because all the lending goes in the platform. That's not the company. So we are in a seed round, a 2 million seed round. We have already 1.3. But we wanted also our community to participate. So we just launched a crowd equity campaign with Token City, which is a platform that is registered and everything. And so this will accept 131 tickets of 1,527 euros every ticket for our Epic Hubbers, as we call it, our community, or any of you who wants to participate into this equity round. We have already it's going to be open on the 5th of June, and we have already whitelisted over 30, almost 40% of it, right? More or less. Thank you for asking. More question? Yeah.
And you said there was a class of investment that was only $1,500 or $1,500.
Yes, that one. I say 1,500, that's 1,500. Okay, you can visit Token City. No, Adventurist, and we will share the link in the group. Thank you.
If you want to expand more, I think it's very interesting that you have both an interface with the traditional investors market and an interface with the crypto market, and you can get it from both worlds. You have
How to work with both of them? Yeah.
We were one of the very first use cases for DAI. We went because at the beginning the loans were with Ether. We were one of the very first use cases for Magic because asking Web2 people to download MetaMask, install MetaMask, open a wallet, blah, 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 is super complicated. So we have a platform, more Web2 approach, is more like crowd lending approach, which is app.ethichub.com, where you select the project. This is not that Web3. Each project is one smart contract. But our vision is to move everything to what we are doing in Celo, which is this pool lending system where you choose the length of your lending, the longer term, the higher yield, and this is credit lines for the borrowers. So we don't have hundreds of smart contracts anymore, as we had in this previous platform, but still keeping in the Magic thing and the Visa fiat on-ramp, so to make it 10 times more affordable. We had to build our own fiat on-ramp in 2018-19 because not all alternatives were impossible to pay. If they ask for 5% on the way in and 5% afterwards in the way back, that means your 8% is lost in fees for the fiat on-ramp. So that's a nonsense. So we had to create one ourselves with no cost for the users. So, but only for lending. So you can buy crypto for free with your Visa in Ethichub, but first it goes for lending. And then when the loan is paid back, you can do whatever with your DAI, XDAI. This is in Gnosis Chain for now.
I would like to add a little bit about the incentives for the farmer. We say we are kind of tokenized trust because this is a circles of trust and theory of game on blockchain. Anyone can invest, but you can only borrow by invitation. So to make a small explanation, imagine we're going to launch a 10K pilot. We ask the community, the cooperative to stake 20%, 2K on it. But if they pay on time plus the interest, they can access to a higher line of credit without increasing the collateral. Why? Because now the collateral is more valuable because it is fed with your behavior, with your trust, with the reputation somehow. So this is a way of redistributing the well-doing of all the stakeholders, kind of in a cooperative of trust where you keep working and growing because of the projects you select. And even when we have this token to cover for default, our incentive is not to sell it. Our incentive is to find communities that are able to work with the money and pay it back to keep all the system trustworthy. So now, thank you very much.
Yeah, and now we have lunch at 1:30. If you want already to prepare to go to the river, maybe we can have a quick lunch and then go to the river. I don't know, what are your thoughts? And by the way, we were thinking of having the tokenomics session in the afternoons, like at 6 p.m., like every day. So if today we want to continue the discussion on region economics and maybe integrating with Ethichub, with having a discussion on how to
Maybe if we have an hour, maybe we can talk about how we can integrate.
Yeah, that's another way for that. All right. Yeah. Yeah, finding out when lunch is exactly. Just some hike preparation stuffs. We will drive a car to where the hike starts, so we can transport stuff like beers, stuff to sit on, because on the way back we can stop by the river if the weather is nice and have sessions there. If the weather allows for it, it's really great. We can fill the car with blankets and other stuff that you might want by the river but don't want to take on the hike. Also, Matthew requested 10 strong, half-naked men to carry wood from the river. So whoever wants to volunteer for that, Tim is leading the charge. And that should also happen after lunch or at lunch before we go. Okay, so we asked the cook if it's ready earlier, so we can eat earlier and go earlier, and we avoid risking sun going out. But in the meanwhile, can yeah. I don't know. Where do we want to start? I know it depends on what you want to deepen, or if you want to. Okay.
Yeah. So I think yesterday I couldn't be the full time because I had a call, but so I don't know how much you ended up with the thing, but one of the reflections is, okay, in the case of Region Network, it was more about creating demand. No? It only had a small demand for the token because it was used only for transaction fees, and it's not a network with high transaction demand because it's not like a trading DYDX thing or something like that. So in our case, I think it's more about, can you open the presentation again? Because there is the circle. It's more about redistributing the tokens because still are super concentrated. Yeah. So how we distributed ethics originally, we had some examples, no, that had to do tokenomics 2.0. So we didn't want to create a new token in the future. So we prefer to, okay, we just distribute a small amount now, so we still have the capacity to do, to learn how tokenomics should evolve in the future. So we only pre-sale 5% of the tokens, which is most of it what it is in circulation. 10% is for the equity company, 10% is the team invested long term. The equity tokens are being redistributed to the equity holders in the equity company and vested long term for sure. So we still have most of the inflation. So 50% we said we send it to the compensation system because at the end the main goal of ethics is to create collateral for the farmers. And 25% is inflation, is incentives. So this is fixed supply, contrary to Region Network. Here is 100 millions, no more ethics, and we have to think how to redistribute this in the long term. We have 16 years inflation here until this is fully distributed or unblocked, and still is not governed by a DAO, but that's the idea, that we implement a DAO. And so part of this is to incentivize the community to participate in this future DAO. And for now, the inflation that has been happening, we save most of it, because why offering over 100% interest on your staking? It's a nonsense. So we just didn't use all the inflation, we have like 4 millions here that we can rethink what to do with this 4 million ethics in the future. Part of it, we want to use it for ambassador programs, and part of it, we want to use it. One of my ideas regarding tokenomics of ethics is because there is a lot of critique of this fixed supply thing. So I would put maybe 2 million ethics in the last tranche when 16 years is over. So part of the part that we saved when there was a lot of inflation, part of it, we put it from year 16 to year 100 or something like that. No? So you still have some inflation, but super small after year 16. And the other part of it is what to do with, if it's really needed 50 millions in the compensation system, and how we can create value with that. Other protocols doing lending only have 10%, 5%, 15%, 20%, maybe 50% is just too much. So that's a bit of my internal questions behind how we could improve ethics. Any?
So how is this pool governed? If you were going to change something with this pool, who would you talk to?
For now, we are very centralized. It's governed by the equity company. We act as a DAO. Everything we do regarding ethics is in the forum. It's not implemented the decentralized governance, so it is not like there is a voting that activates or desactivates the decisions, but at the end we consult and we implement what community does. No? But as it is a small participation and there could be problems, we consider decentralization is in a complex system like ours. If you are doing just something like liquidity, no, or which is just take Ether, you mint stablecoin. That's it, no? And there is ratios and liquidation process, and that's it. You can hard code it, so you don't need any change. But in our case, that we are facing the unknown, working with a theory of gains and in practice, changing the ratios, no? For example, now that we want to lend, instead of cooperative of farmers, to a startup selling solar panels to smallholder farmers, so they have light. The ratio that we have to ask for that project, the collateral ratio should be higher. This ratio has to be adaptable for at least for some years until we really understand how actors behave. So for now, we can change, even the ethics is a proxy token, so we still can change supply and whatever, no? For sure, we don't want to do it ever. But for now, it's not hard-coded anything here. So, no, I think maybe a brainstorming about what to do with, what will you do with the how do you say, with the 4 million that we have available is one thing we could do now, and the other part of it is one of the weak points of ethics for now is lack of liquidity. We only have like 500,000 in liquidity. It should be much more than enough, because at the end we have 1.2 million outstanding debt. But for sure, for people to trust the system, it's not only that this is collateral, but it is liquidity enough for that collateral. So we have to incentivize creating liquidity and not, for sure, like short-term liquidity, incentivize liquidity, but long-term protocol control value liquidity that cannot go, or at least long-term liquidity. Yeah.
I just have a thought. It's very complex. Probably would need to draw some things out and really think in a few different dimensions. But it seems like there's a potential with a fixed supply token to use it as a reserve to launch a bonding curve or commons market maker. And I think perhaps considering a design where there's ethics along with an opportunity for what we call a hatch to launch an augmented bonding curve or any whatever primary issuance automated market maker, that you would have a dual reserve where you would have opportunity for people to buy in at a flat rate before the curve is launched to get additional liquidity in USDC, DAI, whatever it is, whatever currency that you think the network would like to have liquidity in. I don't know of any designs that have multi-currency reserve yet, but I think this is definitely coming and has been a thought for many people for years. So I think for you, this would anchor your existing fixed supply token, give it some new life. But of course, this is like huge design considerations for how something like that would work. This is just like an intuition or an idea. So it would be interesting to explore that with some token engineers of what something like that could look like. And maybe even some of the mutual credit brains as well into something we may not see in the value flows of the network that could provide additional value or liquidity or reduce the need for liquidity, as some have been discussing in, you know, the balance sheets or the accounting. Can we save liquidity, which I think is one of the messages that I've enjoyed hearing from here, because we're always like, we need more liquidity and more. It's like, really, we don't have infinite liquidity. So where can we save, looking at where can we save liquidity as well in the network as considering an additional token design?
Yeah, I fully agree that that's a good idea. Also, Jeff was proposing something similar. So I understand the point is setting part of this 4 million ethics within this bonded curve, right? And implement, I understand, implement some vesting for sure, no? For the people who can buy there with a discount, etc. Yeah. That's something for sure that we have to implement. I think so, no? It's very useful. Any other thoughts?
Yeah, on the multi-token reserve, I think you may know Minto protocol, which is like the stable asset protocol on Celo. And they use multiple tokens such as, you know, DAI, Bitcoin, ETH, a couple of assets that are non-crypto correlated as well. And that has produced like quite interesting results. And these are in the form of like carbon offsets and like other tokens that can like back your token. So one thought there, if you find projects that you're motivated to add like some form of governance or just introducing governance such that these other tokens can potentially be added to your reserve in future that are ideally not crypto correlated or like less crypto correlated, so that market changes, etc., may not necessarily affect the movement in price of your token. So as much as possible, like having all of it like vested in one basket can result in less stability in the long term, especially through market cycles. So that would be like one recommendation I have, which is like less crypto correlated assets in your reserve if you're doing a multi token basket.
Just adding to that as well, and thinking around what you're optimizing for, there are designs that optimize for price stability, and you can also
in our
and
case,
also like making the value of the token tied to the actual overall growth of the network, or loans, like looking at what are the kind of KPIs or optimization factors, and that may be multi-dimensional.
I don't fully understand your point. So for sure, ours is not that related to stability, no? Because it's not a stable coin. It wants to reflect the trust, no, in the network. If there is little defaults, ethics go down. If there is many defaults, ethics go up. So maybe is the end goal, the target, the KPI, to really keep the defaults low so it can grow. And this is the logic behind it. So I don't know if I can understand you with this behind.
I guess I was trying to understand, like, yeah, what are the primary considerations, and what would this bonding curve token, what would you want it to reflect?
You have to
answer.
Yeah, okay.
I had another question, there's point. At the moment, you just provide coffee to the roasters, right? You sell it to businesses and not to consumers. Am I right?
Yeah, the equity company business model is buying, selling coffee. So leveraging on the financing of the lending protocol when we are the auditors.
Now I was thinking, given that in these days sometimes it came out the, sorry, I don't have the proper language because I'm not a technician, to obtain returns that are non-financial, but in coffee, for example. For example, I want to drink a teacup coffee for the next 5 years. So instead of buying it every time, I invest into the system, and my revenue is receiving coffee regularly, and then you can optimize the supply chain. When you have B2B and B2C better structured, it will be also money efficient to have the returns in use value instead of money, because you reduce financial transactions. What are your thoughts on this?
Yeah, we are trying things like that. The problem is not that to putting in the token the physical product. It creates a disbalance in scalability, because at the end, scale coffee selling is very hard, and because it's much more connected to the real world, and you need a team and logistics and everything, no, for that. While the lending protocol could be theoretically scale exponentially, right?
Yeah, maybe you don't even have to do it yourself, but you can have some external entity that take this mission, and then you optimize the payment graph, and you check if there are ways of shifting credit or what else to, I don't know. Yeah, would be cool.
Or an ethic hub in each city with a storage warehouse.
Yeah.
Yeah,
the new Amazon.
I can tell you 3 ideas or 4 ideas we have in this regard. One is what we are doing for now is 1 kilo, 1 ethics. So that means when a roaster buy ethics, we give the farmers buy coffee, 1 ton of coffee. That means you are giving the farmers 1,000 ethics, right? So that way, we send to the farmers already like 100K in ethics. It's a way of redistributing ethics towards the farmers, because they created other value besides paying back the loan, which is create a good coffee that has demand in the market, etc. Second way I envision this personally is tokenize the coffee of the farmers. In my first presentation, the Apple that I wanted to set where how I see the financial system, no? That is local currencies are super cool and is a unit of account for local trading. But if you want to sell coffee to somewhere overseas, that is priced in dollars, unfortunately, for now. And I hope someday it's priced in some other hard currency, but it should be, I think, in order to be an international unit of account, much of a harder money thing by something that could be, for example, coffee and things like that, no? Especially shadow grown coffee and other commodities that we need for living. So that's one way to land this idea of how to use coffee, no, to provide value to the farmers. The other thing we are doing is we created, this is a new experiment, is like a certificate. You are a crypto social entity. That means you accept ethics in your coffee shop, or, I mean, this is for coffee thing, no? You can do it wherever, but for now, we have the 2 cafeterias in Madrid, which accept the payment in ethics, and they stake those ethics on behalf of the farmers. So it's not you are altruistic at all, because it's just you are accepting something that creates value for the farmers if you stake it as collateral, but the day you need the money, you can sell it. No? So I think that's an interesting idea. Nobody have tried. Let's see how we can do it. And it's a way, again, of leveraging, because this is for the cafeterias that have ethical coffee, for sure, too.
But the person buying coffee with ethics is not removing it from the state.
What it means is social responsibility, traceable on the blockchain, because what they do, it's La Bicicleta, it's a very well-known restaurant there. They accept payment of ex-Benedict coffee or whatever you buy there, and you can pay with ethics, with the equivalent in ethics to the menu, to the euros you're charging. What they do with that money, they don't sell it, they stake it within Ethic Hub system. So they support the farmers. So that's why they say it's social responsibility, because they use it for something positive, giving collateral to the farmers. But the nice thing is that two-sided, because if they in the future have a problem, economical problem or something, and they want to retrieve back that support that it's staked, they can cash out and have the money. So it's nice that you were helping someone, and in times of need, when you need back the help you were doing, you can take it. Just keep it liquid somehow. But it's trustable. It's not like getting a big corp or whatever seal, but you can say, this is my wallet. You can follow the hash and see that really I'm supporting farmers in other side of the world.
So this is getting more interesting for the following reason. So do I understand directly that the credit is being given a different unit of account to the ethics, which is what is the equity, the stake, basically, right? Hold on. So I heard a stake as collateral, right? And okay. So yeah. But what I find really fascinating at this is that you've created its own self-closed loop network. When you're taking care of the commodity flow, the coffee, and you create an interface for the commodity through the Ethic Hub, right? That buys basically guarantees, it underwrites the productivity of the network by saying, like, I'm your connection to the markets. Mm-hmm. And you're creating a bridge towards the crypto, right? Through the ethics. Through the Ethic Hub company, you're always creating a bridge to the capital markets, right, for investment. So you have now two sources of investment. And the question that I have in here is like, how does one gain share on the Ethic Hub? What's the process of selling and buying your shares in the Ethic Hub company? And how does that link as a backing of the ethics and the other way around?
I think the exit for your equity, if you want to see it like this way, my ideal exit is as the company, equity company, have ethics. At some point in history, we can decentralize the equity company and by giving the ethics to the equity holders. That's one way of exit. No?
Okay.
Yeah, and the other one at the end, the most probable one, because that would be that we are super amazing and we become a super big thing, blah, blah, blah. I think at the end, in some point in history, we should merge this company with a huge roaster or huge coffee buyer, no? Or a commodity buyer, so we can scale almost infinitely in the selling side.
In the selling side, because as a unit, I think it's really good because it contains all the commodity aspect, the connectivity. You have the stake, the equity market connectivity, and you have the credit market connectivity. So basically, the same organizational model, the sort of business model, because I'm seeing it as an abstraction for a hybrid crypto legal, basically economic interface and economic entity. The scaling, that can be sorted out in a number of different ways. Like we'll keep the conversation open in Ko-Fi, but as a business model for me, it's really interesting because you figured out all the connections with the different aspects, the commodity, the stake, the equity, and the credit, and how to create an internal loop so you don't depend on external economic loops. Like one of the things that we are presuming for we're designing the economic space protocol and all of that is that no one entity will have the three capacities. But this shows that you can design these hybrid organizations from the ground up with this template for any number of different things other than just coffee farming. And again, the validator part is great because you're valuing the performance of the network, of the farmers in this case, and validating it and making sure it has value. And you're also underwriting it, right? So just want to recognize for the design work and the applicability and the groundedness on a use of this model. And want to say like what you're providing, what you're offering the community here is not only this particular performance of supporting the farmers, but a template for like supporting all sorts of social causes and all sorts of communities.
We call ourselves Ethic Hub, not AgroFund, not Coffee Hub. No, at the end, I think it's a new way of doing things. No? And the idea is with these guys, the auditors, for example, the example I was setting with this crowd solar thing, no, is a platform for supporting solar panels suppliers, no, locally to smallholder farmers in different countries, blah, blah, blah. So they were doing this with paper contracts, no platform, no fiat money, bank transfers, etc. So now, and they had even insurance thing in a bank account, you know, and somebody granted some money to have some collateral so no people lose money when lending to the farmers. But so they can buy ethics, become an auditor, and bring here their suppliers of solar panels as loan originators. And in that case, they have a business model. We, as an auditor, we have a business model regarding coffee. They, as a auditor, they have a business model which is selling electricity, basically. No? So you pay back the loan with the invoice of the electricity to the farmer. and you are creating value because basically they are saving money besides improving their standards of life. They are saving money because they are using kerosene and things like that and spending a lot of time in cutting wood and everything, because that's the alternative they have for heating up or whatever.
So basically, you're basically have all these points of increasing the network,
That's how we see it. For sure, this is super hard to scale and have super small funding. So at some point, I hope we can scale this much farther.
No, I'm just handing you the mic so the live stream can hear what we're talking. Food is supposed to be ready, but it's not ready yet.
There is another question over there.
So I had a question on the assumptions that you make regarding the ethics tokens movement over time. It really does rely mostly on the insurance product, correct? On the insurance product receiving more than you emit, I guess.
The main demand drivers for ethics and the more value-driven source for ethics is 4% we take in each loan. Why 4? Because, as I said before, average worldwide is 3% default for this kind of farmers. In each, auditor has to, in some way, we have to evolve to different ratios. This, at the end, will be proof and error in ratios. This, at the end, will be proof and error and in different sectors, etc. The point is, you always have to take more for the compensation system, for the insurance, that what you take out afterwards. When there is a default, you sell ethics to cover for the default, for sure. If we have a huge problem and there is 30% default, ethics will go down, for sure. But the idea is that we are aligning the incentives to keep the default contained because of this skin in the game system for all the stakeholders. And for now, it worked. So I took 4 ideas here. One is the bonding curve. The other one is multi-asset reserve. So the way I see the multi-asset reserve in our case, I don't know how you see it, is more like liquidity against other tokens, or maybe indexing. No, you can. With Celo, we have proposed to create the ReFi index. So we put together some ReFi tokens, and this is a way. And Celo set a big amount of Celo in it, so it has liquidity for other to cash in, cash out, etc. So that's a way of doing multi-asset reserve that provides liquidity for the token, which is, I think.
I think a lot of the solutions are basically different ways of saying the same thing. Because if you have a multi-asset basket, you have some exchange between those assets in the basket, and the bonding curve is essentially just the algorithm that defines that exchange. And it may be dynamic, it may be static. In a lot of these liquidity pools, it's like a fairly basic X times Y equals K is the most basic, but in a multi-asset basket, you have a bit more nuance. But the bonding curve is just the algorithmic exchange ratio between those. And you can do it very simply, or you can add in a lot of different sort of signals into that discovery algorithm as well, price discovery.
Because our implementation was with symmetric, which is
Mhm.
Case, you still consider, so our implementation, so for the record, is that we had in thought is as other indexes are working, which is with Balancer 2.0, so you can have multi-asset thing. And the resulting token has liquidity and is an asset that can be interesting for a wider audience, no? Because maybe people don't want to invest in Ethica, but want to invest in refi, and so as a collective asset. So I don't see how, if that logic works, if doing that, the multi-asset reserve with a bonding curve.
So I would say it's an exchange bonding curve rather than an issuance bonding curve. So, and actually, we're trying to publish an article right now trying to differentiate these. So one you can consider a supply discovery market, and the other is a price discovery market. So but it's the same mechanism essentially. You're defining an invariant between reserves entered and tokens issued, or exchange between two assets that already exist. So it's just a matter of curves, but one is for supply discovery. So how many of your tokens should be in existence? There needs to, or there now can be a mechanism that there's a dynamic give and take for the increase and decrease of your token supply. Sorry, food is ready. But I think these things can be composed in many different ways. So you may get some of the same sort of stability from a multi-asset reserve. But what, sorry, I don't remember his name, but what he said about the multi-asset reserve was if you put in tokens that have, essentially fiat issuance, so you don't have a controlled market price, it's just what people are willing to pay for it on the Uniswap. As soon as the market turns, all of the tokens in the basket drop. Collective investment kind of follows, it's correlated with the crypto market. So this is part of the issue, is that all of these fiat tokens, and I'd say that kind of loosely because I know fiat is a particular thing that we use to describe nation state currencies, but essentially the lack of bounding in the supply creates this like correlated downward, you're all just relying on the same market froth essentially. But if you use a, so this is where you use a bonding curve for supply, issuance, and redemption. Then you create a separate sort of market value that is resting upon. And that's not saying that it's rock solid. Your reserve can run out if your token goes to zero. This isn't some magic money machine. If you're producing no value and everyone sells your token, it'll go to zero. But you can do really interesting things with like stacking different functions, so that you have one stakeholder group that values this, and you have a different stakeholder function that values that, and there are different sort of points in the curve's value that different attributes of the tokens are valued. So you create kind of like a spread between different stakeholders, where this group values this, that group values that, and you can kind of offset this buy and sell pressure. And then I'm hopeful that we can create DAO meshes that aren't just correlated with the market, because they're fluctuating around the value that they're delivering in their ecosystem and not just the whims of everyone buying and selling crypto assets in general.
Yeah, I like it a lot. So the point is, how much of the supply should be deployed here? I don't know if you have some numbers about some recommendation in this regard.
That's some of the modeling we're doing with the Bonding Curve Research Group now, actually. And I think there's so many moving parts, but I think we can start to ask these questions and then run models with different buffers and see where, like, this is just engineering design. You have to figure out where it breaks. What is the risks of or the buffers needed to protect against catastrophic failure? And you have to push the system to that failure state and then go, okay, anything beyond this is danger zone. So what are the agent permissions we have to restrict in the border danger area, so that the system cannot be tipped into default? And I think these are insurance pools, mutual aid pools kind of thing. Same thing with resource. It's a way of using these assets to sort of collectively offset the risk, which I think is really cool.
Yeah, super cool. And one very last point, I forget, and Will is not here, but just for you to have that also in mind, is the stewardship thing that Gabi told about. No, is as we have said, our farmers are excluded from credit markets, eco credits, whatever. No, I have been trying to convince Regen Network to deploy a super soft methodology so they can access, and even that didn't work, you know, because the problem is we don't even have the polygon, so we don't even have the satellite imaging to do the softest MRV possible. So our idea, and I don't know how to implement ethics there, the demands for ethics there is, okay, now we are creating a new token, which is the stewardship token for the farmer. This, you have 2 hectares, you have 2 tokens, and you are doing shadow grown coffee. This is my work as an auditor that to verify that you are doing coffee production with no, how do you say, no intensive way with trees, etc. We can extrapolate some data, but not enough for traditional credit markets. So our idea is we blend these 2 tokens with already audited carbon, and we sell them back with a premium for people that want to do the offset of their emissions with social impact and carbon sequestration that cannot be measured, but it does exist, and biodiversity preservation that cannot be measured, but it does exist, etc. No? And maybe you are also having in your mind that in some day you can do the retrofunding, but because will be the data enough to validate how much money, how much carbon sequestration you did by buying those tokens from our farmers, right? But I don't see how to apply ethics there yet.
Let's keep chatting. There's a lot of ways you can tie it into the loop. I think it's similar to the regen.
It's not grabando, ya no está grabando, así que da igual.
Similar to